All right, let's just dive right into this explainer. We're talking about demystifying the financial tools that literally protect companies from unpredictable market turbulence. If you're dealing with corporate finance, managing a company's debt, or really just trying to wrap your head around how massive institutions protect their bottom lines, you are absolutely in the right place. Today, we're looking at exactly how organizations manage interest rate risk using two incredibly powerful tools: forward rate agreements and interest rate swaps.
So, here's our roadmap for today. We're going to cover the interest rate threat, benchmarks like KIBOR and LIBOR, locking in rates with FRAs, the absolute magic of swaps, and we'll finish up with credit arbitrage. Let's get to it.
Part 1. The interest rate threat. Because before we can really talk about the solutions, we need to understand our villain here: the unpredictable threat of interest rate volatility. Imagine you've meticulously planned out your corporate budget for the year. You factored in your costs, projected your revenue, got your debt obligations dialed in, and then, out of nowhere, macroeconomic factors shift and the central bank decides to hike interest rates. What on earth happens to your bottom line? Well, if your company is holding variable rate debt, your interest costs instantly shoot up. But on the flip side, if you're locked into a fixed rate and market rates suddenly drop, you might find yourself at a massive competitive disadvantage against rivals who are suddenly borrowing much, much cheaper money.
Let's put a real number on this, just to put things into perspective. Say a company borrows 500 million rupees from a bank syndicate at a variable rate. A tiny, seemingly negligible 0.25% rate increase, that instantly costs the company 1.25 million rupees in extra annual interest. Just 0.25% fluctuation, and boom, over 1 million rupees in cash flow is totally wiped out. So the big takeaway here is that interest rate risk isn't just a theoretical concept. It's a very measurable threat to your cash flow. It's essentially the probability that your asset values drop or your liabilities jump simply because rates unexpectedly fluctuated. And this risk goes through the roof when inflation and market volatility are high, because nominal interest rates are so closely tied to inflation. Frequent, unpredictable changes make long-term planning nearly impossible.
Moving to Part 2, benchmarks, specifically KIBOR and LIBOR. We need to know the baseline language banks use before we can shield ourselves from this volatility.
Now, what's really interesting here is the stark contrast between the two main borrowing environments. On one hand, you've got short-term rates. These are your wholesale money market rates for borrowing overnight up to about 12 months. On the other hand, you have long-term rates, which are essentially corporate bond yields. And those long-term yields aren't less based on government risk-free rates. They're heavily influenced by the perceived credit risk of the specific company issuing the bond. Naturally, higher risk means investors are going to demand higher returns.
So for those short-term variable bank loans, rates are usually set at a margin above a standard benchmark. In Pakistan, you're looking at KIBOR, the Karachi Interbank Offered Rate. Globally, you'll often hear about LIBOR, the London Interbank Offered Rate, though, as you probably know, that's transitioning to new standards like SOFR. Just a quick reminder, whenever you see loan terms like KIBOR plus 150 basis points, remember that 1% equals 100 basis points. So the bank is literally just taking that baseline KIBOR rate and slapping a 1.5% profit margin right on top.
Part 3. Locking rates with FRAs. Let's look at our first major financial shield and see exactly how short-term forward contracts build a wall around your budget.
Okay, so a forward rate agreement, or FRA, does exactly what it says on the tin. It's a binding, over-the-counter contract, meaning it's negotiated directly and privately with a bank, that lets a borrower fix an interest rate today for a short-term loan that starts sometime in the future. Now, it's absolutely crucial to note that an FRA is based on a notional principal amount. You aren't actually borrowing the money through the FRA itself. You're just setting up a separate side contract that guarantees the interest rate on an amount that matches your actual planned borrowing.
The naming conventions can seem a little weird at first glance, so let's break it down. Take a 3v9 FRA, sometimes written as a 3/9 FRA. That simply means you're locking in a rate for a 6-month borrowing period. The 3 means that the interest period kicks off exactly 3 months from today. The 9 means the period ends 9 months from today. So it's essentially a 6-month window of protection that you wait 3 months to start.
But here's the real quirk of an FRA, how it actually pays out. Normal interest gets paid at the end of a loan, right? Well, an FRA settles up front, right at the start of that notional period. The bank compares your locked-in FRA rate to the actual market benchmark, like KIBOR, on day one. If the market rate is higher than your fixed rate, the bank pays you the difference.
But since you're getting that cash up front instead of months later at the end of the period, that settlement payment has to be discounted to its present value. You then use that upfront cash to offset the higher interest you'll be paying on your actual variable bank loan. Pretty clever, right?
Which brings us to part 4, the magic of swaps. Because what if you have a long-term loan and you need protection that spans years, not just a few months? This is where interest rate swaps really shine. A swap lets a company trade their variable interest rate for a fixed one, or vice versa, over a period of several years. And the absolute best part? You can do this without ever having to touch, renegotiate, or cancel your underlying bank loan. You simply enter into a parallel swap agreement, exchanging streams of future interest payments based on that specified notional principal.
To see how this creates a safety net, just look at the cash flows of a standard, plain vanilla swap. Let's say a company has a variable bank loan costing KIBOR plus 1.50%, and they are terrified KIBOR is going to spike. So they arrange a swap with a bank. The bank agrees to pay the company whatever KIBOR is, and in return the company pays the bank a fixed rate of 5.80%. Notice the math here. The variable KIBOR the company gets from the swap perfectly cancels out the variable KIBOR they owe on the loan. The floating rates literally vanish. You're left with a rock-solid, predictable net fixed cost of 7.30%. That's your 1.50% loan margin plus the 5.80% fixed swap payment. It's an incredibly elegant solution.
All right, part 5, winning with credit arbitrage. This is probably the most fascinating part of this explainer. Using swaps not just to protect yourself, but to actively, almost magically, drive down your borrowing costs.
So, the market is always hunting for credit arbitrage opportunities. Take a look at this setup with Company A and Company B. Company A has a weaker credit rating, so naturally, they pay more for both variable and fixed loans than Company B. But pay close attention to the gaps here. Company A pays 1.0% more for variable debt, but only 0.75% more for fixed debt. The gap in their fixed rates is actually smaller than the gap in their variable rates. And right there, that creates a hidden 0.25% inefficiency in the market.
Now, actually capturing that inefficiency takes a precise 6-step process, which really just goes to show that complex finance is often just about following a good recipe. Basically, if Company A wants a variable rate and Company B wants a fixed rate, they do the exact opposite in the open market. Company A borrows fixed and Company B borrows variable, simply because that's where their respective comparative advantages are. Then they use an interest rate swap between them to trade those obligations. If you structure that swap correctly, using those 6 steps, both companies get to split that 0.25% market inefficiency right down the middle. The end result, a permanent 0.125% discount on both of their respective loans. Company A gets a cheaper variable rate than the open market offered, and Company B gets a cheaper fixed rate. It is a genuine win-win, engineered entirely through the power of swap contracts.
So, just to summarize our main takeaways for today, make sure you keep the distinct use cases for these tools clear in your mind. FRAs are short-term, single-period instruments. They're binding contracts that lock you into a rate for an upcoming period, and they settle up front. Interest rate swaps, on the other hand, give you that dynamic, multi-period flexibility over a span of years, letting you totally transform your liability profile from variable to fixed or fixed to variable without ever messing with your original loans.
As you look at your own financial strategies, or when you're analyzing corporate balance sheets, ask yourself, which of these tools is better suited to shield hard-earned revenue from the unpredictable swings of the global market? Will you lean on FRAs to lock in short-term security for a looming cash crunch? Or are you going to use swaps to dynamically engineer long-term growth and exploit market inefficiencies? The tools are sitting right there. It's just about how you execute the strategy. Keep learning, keep analyzing, and I'll catch you in the next explainer.